Hey guys, Jacob Pruitt here, founder of GMB Financial Services, and today I'm actually going to talk about Wealth Building 101. There's a lot of misconceptions out there about how you actually build wealth, and it's not a fast track scheme. It's not something you can just go throw some money at something and get rich really fast. It happens 0.0000001% of the time, okay? It's a strategy. It's a way of optimizing all of your assets that you have working for you and having opportunity available to be able to get the assets for other opportunities that become available over time. So there's a key to that. You want some safety with a lot of your money, something that's going to give you a good rate of return, that's safe and secure, that when the market drops or other opportunities become available, whether it's the housing market drops or anything like that, you have safe money you have access to be able to take that money and put it towards the opportunities when they come available. But here I'm going to talk about 3 asset classes. We're talking about your savings account, we're going to talk about how your home works, and you're going to talk about this 3rd asset class here that's safe and secure, that grows tax-free. It grows tax-deferred. When you do it right, dealing with someone like me that understands the tax codes, it actually grows tax-free. You have access to it tax-free and so on and so forth. So let's go through this for a second. So let's take a savings account. A savings account is an asset class. If you're earning 1% on your savings account, let's say $100,000, and I'm just using these to keep the numbers simple for yourself, you're going to earn about $1,000 a year in interest. Okay, now let's take your home for a second. Let's say your home appreciates at 5%. This is just to keep the numbers simple, guys. Don't have to worry about your home appreciating at 5%. You're going to say, well, my home has appreciated at 5%. Well, you're right, it probably hasn't. Some people will say, well, that's not high enough. My home's appreciated 10%. Maybe it has. There's really no way to know. I just want to keep the numbers simple for you guys, okay? So, if your home appreciates at 5%, did you realize your home is going to appreciate at 5% whether you have money sitting inside your home or not? If you take this $100,000 and you plumped it down as down payment, you just wiped out $1,000 of potential interest you could have made. And I've heard people say, I'm going to plump $100,000 in here because it's earning 5%. I'm going to earn 5% on the $100,000. That's not how it works. Your house is going to appreciate off of its worth. So if it's worth $500,000 today and it's appreciated to 5%, it's going to be worth $525,000 next year. If you took this $100,000 and plumped it in there, you actually wiped out $1,000. So rather than having $26,000 next year, you have $25,000. It's just the tip of the iceberg and where most people make mistakes. So let's talk about equity in a home. People will say, equity in a home, it's earning 5%. It's not. Like I said in this example, it's not earning 5%. If you have, let's go back to beginners for a second. Now, if you have a home that you owe $300,000 and it's worth $500,000, the difference between those two is what's called equity. In this instance, it's $200,000 of equity. Okay? So if we could find a way to get $150,000 of the $200,000 and you put it in this safe account right here that grows tax-free, tax-deferred, has no market risk, that's been averaging between 7 and 10%. I went 7% to keep the numbers simple and under realistic. It's probably a lot better than that, but I'm going to keep the numbers at the lowest point. So that would keep it simple. Okay? So if you have $150,000 in here, we take $150,000 over here, you're going to earn $10,500 in interest on that asset class. So now you have 3 asset classes. One making $1,000, one making $25,000, one making $10,500. Now people say, well, I have an extra payment I have to worry about. So I'm going to take the worst case scenario, okay, for payments as of today, and today is July 25th, 2014. Interest rates on a 30-year mortgage are about 4.5% today, okay? So if you took $150,000 out, your payment's going to go up $760 a month. That's $9,120 a year at 4.5% for a 30-year fixed. Now, the interest you're going to pay year 1 on the $150,000 to the bank is $6,750. So, but Uncle Sam says, you know what? Thanks for paying interest to that bank. You know what we're going to do for you? We're going to give you a tax deduction. So we're going to deduct this $6,750 right off the top of your income. So if you're in a 25% tax bracket, you take $6,750 times 25%, and there's your tax savings for the year. $1,687.50. So your payment went up $91.20, after tax deduction, your payment's really $74.32. You made $3,000 that year. So now you have an asset that's giving you $1,000, you have an asset making $25,000, and an asset making $10,500 that you paid $74.32 to get. This is year one. It's going to compound in your favor every year thereafter. The next year this might be $12,000, then $15,000, then $20,000, then $25,000, then $30,000. It gets better and better and better in your favor as this gets better and better and better in your favor as well, because you're paying a little bit of principal that you have to pay the bank. So they're making you pay your mortgage down. So all these numbers are getting better. So this asset class, just so you know, there's some tax codes to it that I have been specialized in my profession. The tax codes are 72E, 101A, and 7702. These are the codes that let you have access to this growth of money tax-free. It grows tax-free, but if you do it right by talking to someone like me, it grows tax-free. That's pretty cool. CPAs don't even know much about this code right here. When I sit down and talk to them, they're pretty happy. So this is what I call badass wealth accumulation. And this is just the tip of the iceberg. This is just one mistake people make left and right in their finances. Let's talk about the next piece. So here's kind of the stock market. It kind of goes ups and downs, up and down, ups and downs, up and down. You kind of relate it to walking up and down stairs of the yo-yo. You know, when the market's doing good, you still got its ups and downs, but it's on its way up like this. So it's kind of like walking upstairs of the yo-yo. And then when it's going down, it goes down the same way. It goes like a yo-yo. It goes up and down as you're going down the stairs. So what if you could, there was actually a survey that was done that said if you could take just the 3 downfalls out of your portfolio over the last 40 years, your income or your wealth would have increased by like 400%. Something ridiculous. I can't remember the exact numbers, but it was a lot. So that's what our strategies implement, is implementing a strategy that you never take the losses in the market, but you get gains up to a cap. So here's a typical market, like I said. And here's our investment strategies, or tax saving strategies, or wealth strategies, wealth building strategies. It's the key. Never taking a loss in the stock market. Always taking a gain, even up to a cap of, say, 15, 18, 20%. Depends on the mechanism we're using for this wealth accumulation. So you really have to ask yourself, what would you rather have? This or this? And I did a blog about it too, just a few days back, about, you know, if you take a 50% loss in the market, you have to get 100% to get back to even, start all over again. Well, what if you didn't take that loss and caught the ride back up? You'd be 100% ahead. There's very key things, okay? So I hope this actually enlightened you a little bit, opened your eyes to really some of the possible mistakes you could be making financially. And you really want to deal with someone that understands the tax codes when it comes to this asset class. It's through an insurance industry, it's through an insurance company, and they're very well stabilized. But if you don't know this code and you don't structure this right, it won't perform that well. It won't perform at 7, it's going to perform at 4 or 5. But that's why you want to talk to someone like me, so I can help you get on the right path. Get all your assets working for you optimally. Like I said, this is the tip of the iceberg. This is just one example of how people are messing up, let's say. So I hope this helped you. Like I said, book a consultation. Now I'm actually doing free consultations right now, and it's only for a limited time. It's a $200 value. I'm going to talk to you for an hour and kind of get an idea of what's going on in your life, and to see what your assets are going on, what you're trying to accomplish. You know, whether it's income for retirement or leaving money to your family, extra money to a charity, whatever your goals are. If you have a business, you want to show some ways to actually minimize taxation, I can do that for you too. Or if you want to make sure your employees are happy, I can show the same strategy for the 401k that looks like this, rather than a 401k that looks like this. This still gives the same tax deductions or tax write-offs for the business. So, hope this helped. Like I said, book a pump below, free consultation. It's like I said, about an hour. It says a half hour. I'm going to give you an hour. There's a lot of stuff to go through. I want to make sure we can actually work together. I don't work with everybody. I want to work with certain people. But I want to make sure we're on the same page about a lot of things, educate you on some of the mistakes you could be making, and get your wealth growing for you again optimally with no market risk. I'll talk to you soon. God bless you. Bye-bye.